Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about American Assets Trust Inc. quarterly report. American Assets Trust, Inc. offers a diverse range of businesses and services through its vertically integrated real estate investment trust, REIT. The company's portfolio includes office properties with approximately 4.3 million rentable square feet, retail properties with approximately 2.4 million rentable square feet, mixed-use property with retail space, and a hotel multifamily units with over 23 units. These services are provided in some of the nation's most dynamic markets, primarily in California, Washington, Oregon, Texas, and Hawaii. The decline of American Assets Trust, Inc.'s AAT stock price by -25.15% over the past year can be attributed to several key financial and sector-specific challenges. A significant contributor was the company's disappointing 2025 FFO guidance, which projected a decline from the previous year's performance. Additionally, analyst downgrades and concerns about dividend sustainability further eroded investor confidence. The mixed second quarter results, with earnings per share slightly below forecast, also contributed to negative sentiment. Furthermore, operational challenges in the multifamily and mixed-use segments, including decreased same-store cash NOI, negatively impacted the company's performance. Broader economic uncertainties and declining revenues exacerbated these issues, ultimately leading to a substantial drop in AAT stock price. The primary drivers of revenue growth or decline for a real estate investment trust, REIT, such as American Assets Trust, Inc., can be attributed to several key factors. Revenue growth is primarily driven by an increase in average rent per square foot, high occupancy rates, new tenant leases, and scheduled rent increases at retail properties. Additionally, the company's multifamily properties have seen an increase in average monthly base rent. On the other hand, revenue decline is largely due to a decrease in rental income, lower occupancy rates at office and mixed-use properties, and a decrease in tourism leading to lower occupancy and revenue per available room at mixed-use properties. Other factors that can impact revenue growth or decline include acquisition opportunities, market conditions for REITs, general market perceptions about the company, dividend payments to stockholders, and capital expenditures. Net income and profit margins overview. The net income of a company underwent significant fluctuations in 2025. In Q3 2025, it decreased by 72% to $5,921 compared to $21,318 in Q3 2024. However, for the year 2025, net income increased by 13% to $7,914,000. The YTD 2025 net income also saw a 10% increase to $67,149. Profit margins suffered due to various factors. The operating income margin decreased to 2.25% in Q3 2025 from 30.43% in Q3 2024. Conversely, the YTD 2025 operating income margin increased to 37.64%. This decrease in profit margins can be attributed to a decline in rental revenue and an increase in property marketing costs, real estate taxes, and insurance. Additionally, the repayment of debt further contributed to this decline. The company's financial performance indicates mixed results when it comes to generating positive operating cash flow. While there are several instances where net cash provided by operating activities is reported as $126,545, 2025, and $166,464, 2024, other sections show a negative net change in cash and cash equivalents of $138,714, 2025. This inconsistency suggests that the company's ability to generate positive operating cash flow is not consistent across all periods. The financial performance of various segments and regions within a company has been analyzed. The office segment, retail segment, and mixed-use segment all experienced declines in property revenue and segment profit, with the retail segment being hit the hardest. In contrast, the multifamily segment showed resilience, with a 6% increase in property revenue and stable segment profit. Regionally, Waikiki Beach Walk entities stood out as a bright spot, recovering $0.9 million in operating expenses for the 9 months ended September 30, 2025. This recovery is an improvement from the previous year, indicating that this region has been able to turn its performance around. Management is optimistic about the company's outlook, citing a strong balance sheet with significant liquidity and capital resources. They expect to continue generating substantial cash flow from operations, which will enable them to meet debt obligations and fund capital expenditures. The company plans to achieve growth through same-store portfolio expansion, property development and redevelopment, acquisitions, and opportunistic pursuit of redevelopment projects. While they may need to raise capital in the equity markets, management is confident that their diversified portfolio and locations will mitigate some economic risks. The company has made significant transactions through acquisitions and divestitures. Notably, it acquired 2 properties, Genesee Park, a 192-unit apartment community in San Diego for $67.9 million, and La Jolla Commons III, a mixed-use property with a hotel and retail center. On the other hand, the company has sold several assets, including its real estate holdings, that decreased from $77,519 to zero between December 2024 and September 2025. Additionally, it divested Del Monte Center in Monterey, California, for $123.5 million. The company has a history of paying dividends to its shareholders. Specifically, for the first quarter 2025, second quarter 2025, and third quarter 2025, it declared and paid $0.34 per share in dividends. This demonstrates the company's commitment to returning value to its investors through dividend payments. That concludes the financial summary for American Assets Trust Inc. Feel free to comment below, and I will be happy to answer them when possible.